Nebius reported just under 600 million of revenue for Q2. For the same 3 months, it spent just under 6 billion of Capex. This is almost 10 times quarterly revenue. At the same time, Nebius raised its year-end contracted power target again, this time to 5 gigawatts. But the interesting part is that despite all the spending, Nebius ended the quarter with around 8 billion of cash. So the question is not whether Nebius has access to capital. It clearly does. The question is where that capital is coming from and what must go right in order to do this build-out. First, we need to figure out what they mean by 5 gigawatts. Nebius defines contracted power as land and power commitments it has secured. That is not the same thing as 5 gigawatts of installed GPUs generating revenue right now. In Q2, Nebius said most of its new deals were signed against capacity arriving in late 2026 and would contribute primarily to 2027 revenue. It also said it plans to deploy more than a gigawatt per year starting in 2027. And this is real execution here. Nebius says all capacity tranches due to Microsoft have so far been delivered, and the second meta build remains on track for early 2027. But the key distinction remains. 5 gigawatts is the build pipeline. Yes, the financial burden though arrives much sooner than the pipeline actually starts delivering revenue. The bullish case got stronger in Q2. Nebius AI cloud revenue reached about 600 million, up 500% year over year. Annualized run rate revenue reached 3 billion. And the AI cloud business produced around 300 million of adjusted EBITDA. Almost a 50% profit margin, that is. But on a GAAP basis, Nebius still recorded a 176 million operating loss, as well as a 190 million loss from continuing operations. More importantly, Capex jumped to 5.7 billion in the quarter. Now look at the cash flow statement. Nebius reported about 2.3 billion of positive operating cash flow in Q2, but deferred revenue increased by roughly 1.2 billion during the quarter and about 4.4 billion over the first half. That is customer cash arriving before services have been fully delivered. The economics are improving, but the build-out is still being financed faster than the profits can fund it. Q2 did make the customer financing model more explicit though. Nebius says that roughly 70% of the deals it closed included customer prepayments, and those prepayments covered about 50 to 60% of the associated Capex. The company now expects more than 9 billion of customer prepayments during 2026 alone. That means that customers are not just promising future revenue. In many deals, they are supplying a large part of the cash needed to build the capacity that they ordered. Microsoft is the clearest long-term example. Its contract is worth around 17 billion through 2031, potentially rising to just over 19 billion. The filing explicitly says that cash from the agreement will finance part of the associated capital expenditure, alongside additional financing. Meta adds another version of the same thing. 12 billion of dedicated capacity, plus up to 15 billion of additional available capacity. The second meta build is still scheduled to begin coming online in early 2027. These contracts are extremely valuable because they do 3 things at the same time. They create future revenue, they bring in cash, and they make the whole financing a lot easier. Nebius also kept raising external capital. In March, NVIDIA invested 2 billion through a pre-funded warrant. Nebius then raised around 4.3 billion through convertible notes. And in Q2, Nebius sold just under 13 million shares through its at-the-market program at an average price of about 225, raising roughly 2.8 billion. Then in July, it entered its first secured debt financing, raising just under 800 million at SOFR plus 2.5%. The vehicle is backed by deployed GPUs and contracted cash flows from an investment-grade customer. So, the funding stack is now very clear. Customer advances, equity, convertible notes, secured debt, and operating cash flow all feed the same capacity build-out. Let's do a quick comparison. CoreWeave reported 1 day before Nebius, and it gives us a very useful benchmark. CoreWeave is already at about 1.5 gigawatts of active power and just under 4 gigawatts of contracted power. It generated 2.6 billion of Q2 revenue and reported about 104 billion of backlog, but it still lost 630 million in the quarter, while net interest expense alone was over 600 million. And in the first half of 2026, CoreWeave paid about 14 billion for property and equipment. That does not prove Nebius will follow the same path. It shows the basic reality of the neocloud model. Huge revenue growth can coexist with enormous capital and financing costs. Nebius is also trying to make the next phase less capital intensive. Under its asset-light partnership model, outside partners can finance and own the data center and the hardware. Nebius supplies the system architecture, software stack, and customer access. It's basically all the things they're good at. Nebius describes this model as a way to turn partner-financed capacity into a high-margin cloud revenue with minimal capital outlay that can accelerate growth without forcing Nebius to fund every single GPU and do every part of the building itself. But it also shifts part of the execution risk onto partners. Nebius still needs those sites to be financed, built, powered, and operated to its standards before the revenue can arrive. After Q2, I would describe Nebius differently. The business is scaling faster. The AI cloud margin is stronger. Demand is clearly there. And we can also see that the company is closing much better priced contracts. The financing thesis has also become much more clear. Nebius spent just under 6 billion of Capex in one quarter, while it generated 600 million of revenue. Nebius also expect more than 9 billion of customer prepayments this year alone. They sold around 3 billion worth of stock, and it continues to use convertibles and contract-backed debt. So investors should watch 5 things. How quickly the 5 gigawatts of contracted power becomes capacity that is actually online. How much of future capex continues to be covered by customer prepayments. Whether adjusted margins remain strong after depreciation, interest, and the full cost of the infrastructure. How much dilution and debt are required to keep the build-out moving. And the last question is whether the long-term contracts remain attractive if GPU pricing, hardware efficiency, or market demand changes faster than expected. Nebius is no longer a company with a demand problem. The only question is whether Nebius can turn this solid demand that they have into a durable return on the invested extraordinary level of capital. And I think they have a very good chance of doing so.